Hello, this is Jeremy North with your educational and economic update for October of 2021. On this month's video, I will discuss major headlines that influenced the markets in September of 2021. Please stay tuned at the end of the video for the always exciting required disclosure statement. Well, September was the first down month in the past 7 as fears of rising interest rates, high inflation, and the Federal Reserve's possible cutting back of bond purchases caused a pullback. The 10-year Treasury rate topped 1.56% last week, its highest point since June, while the Ag bond was down just under 1% at negative 0.87%. The S&P 500 finished the month down 4.8%, the Dow fell 4.3%, and the NASDAQ composite fell 5.3% for the worst month of stocks all year long. Well, as we begin the fourth quarter, the markets are very choppy due to the previously mentioned interest rate and inflation worries, but as well as Chinese real estate developer payment problems. And of course, the congressional issues with the debt ceiling. Fears of higher taxes and continued supply chain issues also are weighing in on the markets. Historically, though, the last quarter of the year tends to be a positive one. According to Sam Stovall of CFRA, the S&P 500 has averaged gains of 3.9% in the fourth quarter and was up 4 out of every 5 years since World War II. Stovall also noted that investors will need to hang tight during the normal tumultuous ride in October, which saw 36% more volatility when compared to the average for the other 11 months. According to Thompson Capital Management, who is a leading market expert in volatility, the VIX, the volatility index, showed little signs of panic in September. Volatility is slightly elevated and showing only tentative signs of demand for portfolio hedging. So this is typically what we call a transition market, as stock prices bounce back and forth, but in a fairly narrow range without signs of a definitive trend. As noted last month, we'll be watching the Federal Reserve and the Labor Department's employment numbers coming out this week. A high jobs created number could affect the Federal Reserve's decision on when to taper its bond buying program. As mentioned in previous months, the Fed bond buying program has the effect of keeping interest rates low. As they taper the bond buying program, interest rates are expected to ratchet upwards. We expect the markets in October to be continuing to be choppy. If you have any questions about how the recent economic reports could impact your long-term goals, I am here to talk. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 636-896-4052 or send us an email. With all that being said, here's the disclosure that I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or as a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North signing off for the month of October. I hope you have a great fall month and see you next month.